Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a business valuation expert focused on strategic planning and exit planning in St. Louis, Missouri. Today, we are talking ERC tax credit information for advisors and business owners with Catherine Tindall. She's a CPA in California, specializing in tax credits, and is also a partner with Dominion Enterprise Services. She's combined proprietary technology with professional expertise with her CPA team and is able to offer a fast turnaround time on credit claims while maintaining a high degree of precision. It's her mission to help business owners in key industries affected by COVID shutdowns, such as restaurants, construction, and hospitality, to take advantage of the employee retention credit before it begins to expire in the spring of 2024. Welcome, Catherine. How are you?
I'm doing well. How are you? Thanks for having me.
And a lot of people over, the past several years have been hearing about various tax credit, various retention credits or bonuses or things like that from the IRS. I don't think a lot of people understand it in depth. But what our focus is today is to kind of briefly understand it, but then does it apply? And if it does apply, or if you don't know if it applies, it's really something that we need to start dealing with sooner than later. And how do you reach out to a professional that can help you? But we're going to start with the basics, Catherine. I know you speak a lot about this topic, but I think we got to tee everybody off a little bit and say, what is this employee retention credit or this ERC tax credit? Because people use a lot of different terms for it, and maybe it sounds like a lot of other tax credits, but it is very unique. Can you give us some background on it, maybe?
Sure. So the employee retention tax credit, it came out during the pandemic. A lot of people didn't take advantage of it or didn't know about it because when the program was originally released, it was back in March of 2020. The rules were pretty different than they are now. And so a lot of people didn't realize it. And a lot of, professionals didn't realize that their clients were eligible for the program. It's basically like a third round of PPP is how I explain it to people. Basically, it's compensation to business owners who kept employees during the pandemic and then, suffered during the pandemic. We can go into the specifics around, who's eligible, that sort of thing. But the credit itself, it's up to $26,000 per employee. So that's the upper cap of what it is. Just to, full caveat there, most companies don't qualify for that full amount. It's very idiosyncratic for companies, but it is can be a very powerful tax credit with even, companies with small headcounts qualifying for six figures, depending on your situation during the pandemic. So it can be a really vital program, and it's still available. It's going to start to phase out on us in April of 2024. So there's still time to take advantage of it. But it is, it is one of those one-hit wonder programs from COVID that's still around, and many have had advertisements, for it, or maybe heard about it a little bit, but there's not a lot of information out there around it.
Well, and I think that, from my experience kind of being in the accounting world and also knowing, a lot of accounting advisors or legal advisors, these tax credits and, what has come out of the CARES Act are nuanced and
Yes.
complicated. And quite frankly, just doing a cursory look or, kind of knowing, oh, ERC, I know what it is not the route to take in some of these specifics. But even at the beginning, I think that business owners don't necessarily even know if they're going to be able to take this credit. So they kind of sit back and I don't know. Should I ask my accountant? Well, I asked my accountant and they knew a little bit about it, but they were a little weary because it might be complex and they don't know enough. Are you finding that people kind of are at that space where there's not everybody knows what's going on? And is it really easy for a company to say, oh, what type of companies are eligible for this? And am I checkbox? Am I one of them?
Yeah. And I would say, that's kind of the key issue that I see with this program is a lot of people fall through the cracks because it's a payroll tax credit. A lot of income tax professionals, the credit itself it can be a very complex situation depending on what your company is going through. And for a lot of practitioners, they didn't want to take this on as a practice offering. And so they left it kind of to the payroll providers to do. But, for payroll providers, it's a big ask because it's a tax credit. There's no software, there's no special forms for us to use. So it really relies on the strength of the professional that's doing it. And so I think between those two things, a lot of business owners can be kind of left out just because their income tax professional doesn't see it as their responsibility to do the assessment. So I think the main thing I usually tell business owners to know about, to see if this is actually something that's been done for you, the first two pieces is, does your tax pro have access to quarterly financial statements for you? Because that's one of the tests that we use. Is it's a revenue test, and it's done on a quarterly basis. So do they have access to your quarterly financial statements back from 2019 through Q3 of 21? If they don't have access to those, then you haven't been assessed. The second piece is, has your tax professional had a conversation with you about, and this is very specific, how the government interacted with you during the pandemic? Was your company subject to operational changes due to government mandate orders? Because that's the other pathway for the program. And so if they haven't had that specific conversation with you, very likely you have not been assessed for the program, because those are the two main pathways for eligibility for companies.
And it's not necessary, like, you shouldn't have an expectation that your accountant is trying to find all the credits possible. Because what you said was kind of important, and it may have been lost on our audience, but tax professionals are focused on your income taxes. And because this is a payroll tax thing that would fall under, we know a lot of large payroll companies, that's not what they do. They aren't in the business to go after these tax credits. So you almost have like a misalignment on who is doing it and maybe who understands it. Would that be correct?
Yeah, no, that's really what I've been experiencing in the field, because I get a lot of work from people who have approached a payroll provider to do it. And then when the accountant got involved in the situation, just realized very quickly the payroll provider wasn't competent enough to do the work either. So you just get this kind of catch-22 where people get left out. And it's, I think the big piece too is, like, for a lot of tax practitioners, they see their first obligation is to keep people compliant. And with this, because it's a bonus program, it's kind of up, a lot of practitioners I encounter don't see this as kind of their responsibility to put this in front of clients, because it's not a compliance issue. It's, just a benefit program. Very similar to like how PPP went down. Some practitioners did all the PPP, everything for their clients. Other practitioners wouldn't touch it. Very similar. It's not really clear from the program who's responsible for doing it. So, I definitely put the onus on you as a business owner, or if you're an advisor, to definitely check this out for the clients, or, check this out for your business and give it a second look. Because even if I had somebody earlier today that I was talking to that had 100 employees, and their accountant had kind of blown them off about it, and, did a little bit, but didn't really dig into it. And I said, well, even if you only qualify for 2 weeks with that head count of employees, like, this is a multi-6-figure issue. And to have somebody just pass you off with an email and not really dig into it, that's not really doing you a good service. So you want to really do make sure you're giving it its due diligence, which is just a matter of talking to a couple providers and, getting a sense for, who's going to be good to do this kind of work for you. And it's not too much of a time commitment really to do your due diligence on it.
Well, and I think that when we're looking at, like, if I'm eligible, and if we're like trying to look at some of the signs of whether I'm eligible, the other thing that I have to consider is that since it's a credit, and it's like not a one time, but like, since it's not going to happen again in some capacity, is it really easy to identify, well, this is what I'm giving up, this is what I'm not giving up? Or, you talk a lot about an assessment and having, somebody kind of at least preliminarily look and see, are you eligible? Are you, is this a possibility? If it's a $26,000 credit for each employee, and you have 100 employees, it would be realistically rational to at least see if you're eligible, because there are other ramifications of it. But like, just preliminarily, like, if some of these 3 signs, it may be that you need to have an additional discussion, not necessarily with your accountant, but maybe with somebody who knows these credits. What are some of the signs that I could at least be looking for to know whether I need to ask questions?
Yeah, so I'd say the first piece is, if you've got over a head count of, I usually tell people 10 employees, you should have an actual conversation with a professional that's going to talk about your specific situation, because I've had people who thought that they weren't eligible from just trying to self-assess, and they missed some nuance, or they missed some loophole, or just misunderstood some of the tests. So that's what I usually tell people. If you've got more than 10 employees, multiply that by $26,000. That's the upper cap of what you could be eligible for. It's worth having, a couple phone calls and really digging into it more. And then for the actual program itself, the things that we look for, the first piece is we're looking for quarterly revenue declines. And so what I usually just tell people is that if you didn't have a quarter over quarter steady revenues or consistent growth revenues, you'll want to have a tax professional look at it. If you have any kind of dips in one quarter compared to the same, so this is for tax years 20 and the first 3 quarters of 21 for most businesses. If you had any kind of revenue dip in 20 or 21 compared to the same quarter in 2019, that could potentially be enough for you to qualify for the program. Now, there's specific limits and everything for the program. So for tax year 20, it's 50%. For tax year 21, it's 20%. But I just usually tell people, most providers will do this assessment for you as a complimentary thing. I know we do. And so why try to DIY it? Just send your stuff over to somebody who will actually run the number and make sure they're getting you the right information. So that's one major sign is the revenue. Not consistent revenue growth or stable revenues over quarters. We're looking for dips. And then the second, like I mentioned, that, government interference in your operations. It sounds really vague when I say it like that, because, that's how I lead that question. We actually have a lot of bright line tests from the IRS. So we're able to, it is a quantitative test. We have to be able to demonstrate certain things, that you meet certain operational disruptions that are going to qualify you for the credit. But we're looking for things like, a restaurant was subject to indoor dining capacity restrictions due to a state order, or you run a chiropractor office with multiple locations and you weren't allowed to run, you weren't able to run your operation at, full capacity because of social distancing requirements that were enforceable by state orders, things like that. And so it's, you want to talk to somebody who's going to get through the nuance of it. But then also we look and find the actual government orders, because that's what the IRS wants. But if you had anything like that going on where the government was, you were directly enforced to do certain operational changes, it's worth having that conversation with a professional about it to see if it rises to the level of eligibility. But that's what we look for.
And typically when we were looking at the PPP, we were also, especially the second round of funding, we were also looking at that kind of volatility.
Yes.
And you were talking, when we were talking about this earlier, you were even talking about like quarter over quarter. If somebody's not analyzing it in that capacity, that could also be another way to look at it differently. It's almost like you should assume that you could get the credit and just see if it's worth it for you to do what is required, right? Because it's not as simple, right? In that capacity. Like it's not going to be an automatic deduction this year, right? It's sort of in the future, or no?
Well, so, I usually tell people, like, assume it's like if you've got like a lump on your neck, it's like, assume that it's cancer until proven otherwise. It can potentially be such a big deal that you want to assume that it's an opportunity for you until proven otherwise. That's not to say that every business qualifies. That's definitely not the case. Many it's really idiosyncratic to what was going on in your company during the pandemic. But yeah, it's, if your company is eligible for it, you're legally entitled to the money. It's not like PPP where it's a limited fund pool, or it could run out, or Congress will change it, or it'll stop. Because it was written as a tax credit, it's like when if you filed an income tax return and didn't claim all your deductions, you're allowed to go back and amend that return for deductions you missed that you were legally entitled to. This program operates the same way. So unlike with PPP, where it was basically once the money was out, if you were eligible but didn't do it, too bad. This program's not like that. So you can still go back and get it. That being said, IRS processing times are really slow right now. So it's not going to come, we're recording this the end of 2022. So you're not going to see any funds until 2023 at this point if you filed today. But, it is, it's once you've proven that you are eligible for it and you have the right documentation, it's kind of an in the bag situation. You're legally entitled to it.
Yeah. And if you're going back and restating or amending prior tax returns, it also is kind of, an invitation from the IRS. So you want to do it well. But I think it's an interesting. I want to talk about some of the pitfalls of this calculation, but I think it's interesting. We didn't talk a lot about your background, and I want to tell people just a little bit, or have you maybe tell them a little bit about how you came about this, because it's not that you really set into like, I'm going to be the expert on ERC tax
Yeah.
credit.
Yeah.
Like, tell them a little bit more, because this is how our industry does change. But, what were you doing and how did you kind of start really focusing on this?
So for myself, my professional career is all tax. That's where I've spent all my time. It's funny, my parents are both CPAs with the tax practice, so it's kind of a in the blood thing. But for myself and my partner, we primarily worked before the pandemic with clients for strategic income tax planning, and then he has a deep background in R&D tax credits, which is, credit programs can be kind of similar to each other. So when this program was released during the pandemic, we decided early on, once we learned more about it, that if you're going to do this kind of work, you really need to be an expert in it. And because we already had the experience doing the R&D tax credits, and then also our team just kind of had a unique affinity for building tools and software and that sort of thing. We saw the opportunity, we did the work for our own clients, and then I'm a member of a tax planning society, and so we offered it to other small practitioners, because for a lot of them, it just doesn't make sense to only do this credit for, say, 10, 20 employees and then have all the audit exposure. And if they don't have a background in credit work, it's you're opening up potential liability issues there for you as a practitioner. And so we started doing these for other practitioners. And then it just ballooned into a practice area, as more practitioners found us, as more business owners found us, because it really is a wonderful opportunity. But for a lot of professionals, it just didn't make sense for them to take it on for, a production standpoint. And, we did. And, I think for us too, the main issue that we see with the program is really going to be the IRS enforcement. And so that was something we put a lot of careful thought into, and we were designing our program and how we were going to execute to make sure that we're ready for the IRS enforcement when it comes, because that's the key problem with this program, is that the IRS, just kind of rubber stamps, processes these claims. They take long enough to do it, but they rubber stamp these claims, and then it's not going to be, another year, 2 years before enforcement really ticks up on this. And because it's such high dollar figures at stake, and there's a lot of bad actors in this space, there's just going to be a massive IRS enforcement effort. They have onboarded a special task force for this program. So it's, that was the key issue we saw with the program and why we got into it and why practitioners work with us, because, it's the IRS audit. That's the thing that's the critical issue.
Yeah. And I mean, as a business owner, if I'm looking at, my accountant, maybe I've been with my accountant for a long time, but they're nervous about filing this or amending it,
Yeah.
right? Because they don't want to take on that. That is what, you and your firm and other firms that are very much specialized in this are prepared to take on some of that risk. And that's some of the piece of it that I think makes me even feel more comfortable about the fact that you're standing behind your numbers, in that you're willing to fight for it. And that could be a unique difference between practitioners that I would encourage people to ask about. Because if they don't, then it's maybe they're just their own personal accountant doing it. And the personal accountant would be like, I don't think it's worth, I don't think your credit is worth the effort. And really, it's the risk of the accountant, not the risk of the business owner, that's kind of pushing them away from it. Right.
Mm-hmm. Yeah. Because if they don't have a background in doing IRS representation work, it's going to work against them because, like I said, there's a gap here. And so if you don't have your paperwork in order now, while everything's available, in 2 years from now, when they come back, are you going to have all the substantiating documentation you need? Are you really confident in what you did? Because this is going to get, this program's going to get heavily second checked by the IRS. And for a lot of practitioners, they don't want to take the risk. And I'd say for most business owners, don't let that ward you off the program.
Right.
Because you're entitled to the money. And it's just, for you as a business owner, the key decision is just working with a good practitioner for it, who's ready for the audit piece. And, for us, I always tell people, we include that as part of the initial engagement, just because I create the audit file when we do the claims. So, when it comes time to actually having to deal with the audit, it's just a matter of sending over some paperwork that we've already put together and, maybe doing a phone call or a letter, and we're done, so I'm not concerned about it. But I know for a lot of practitioners, that's the main fear here. For the business owners, that's the main fear, and it's justified. That's a justified thing to be afraid of.
Absolutely. And I think that that's one of the keys is building that audit file and also knowing it back and forth. But that means that you guys have seen a velocity. You guys have seen so many different situations that you can see what some of the, incorrect calculations are. But maybe you can just tell us like some of the pitfalls of the calculation of the ERC tax credit. And, even maybe where people are just, maybe it's more in depth in certain areas, but people are looking in the wrong areas. But like, what are people really stumbling on, practitioners in this space, maybe?
Yeah, so I'd say the first one that I see practitioners stumble on is a lot of them are unaware. They're aware of the revenue rules. They might be unaware of the alternative quarter election, which allows us to use one quarter's, revenue eligibility to trigger the next quarter being eligible. So the common one I see people miss on that is not realizing that if you have in Q4 of 2020 showing a 20% decline in gross receipts compared to that same quarter, Q4 2019, that actually triggers Q1 of 21 to be eligible for the program. So that's a common one I see people miss. Another one I see people miss is thinking that if they got PPP, they're not eligible for ERC. That's not true. It was originally, that's how the program was written, but that was subsequently changed, and a lot of practitioners miss that. I think almost every case that I do has both PPP and ERC. They do interact with each other. The PPP can wipe out, a portion of the ERC, but it's still, like I said, almost every case I do has both. So that's a common pitfall that people miss. Another really common pitfall that I see people miss is not understanding what's going to be a qualifying government order. And so the pieces that we look for there is that the government order itself is, coming from a state level, coming from some kind of governmental entity, that it's enforceable on the client, and that it's forcing a more than nominal change in the business. So we're looking at a more than 10% effect on their business, and that the portion of the business that is being affected, it's being affected in a more than 10% way. Those are the two bright lines. But a lot of practitioners they're intimidated by those rules because there's some complexity there and some legal interpretation. Like we have a staff attorney that's what he does is, make sure that the government orders are sufficient for what the IRS rules are. A lot of practitioners don't feel comfortable making that judgment call. And so they'll only look at the revenue quarters and not look at the government orders. So that's another common pitfall we see for the program. And then just other calculation pitfalls, things like people not understanding how to do the PPP allocations with regular ERC wages, not understanding some nuances around disqualified wages. So if you have owners in the business and family members in the business, do they need to be disqualified? It depends is the answer. Things like that. There's a lot of little tricky bits that can sway the credit a lot. And a lot of practitioners, unless you've, read through all the IRS FAQs and the legislation we have, you might miss something that's important. I guess one other piece that's a common pitfall that, I should make mention of is that this program has what's called aggregation rules. And so if you have multiple businesses that have a shared ownership structure, we actually have to aggregate them into one claim. And so very often practitioners will miss that what they're dealing with is an aggregated claim. And that can be beneficial or non-beneficial. It just depends on the situation. But I've had companies not think that they were eligible and then didn't realize that they had a sister company that was eligible for the program that then triggers them for eligibility. So that's a common thing that people can miss as well if they're not familiar with the aggregation rules. So those are the most common pitfalls that we see.
And what if we get, I have a lot of clients that thought about taking the PPP and didn't because they kind of
Mm-hmm.
knew that they were still profitable. I do have one client that actually gave the PPP money back because they had certain fiduciary responsibilities and they didn't want to claim that they
Yep.
had taken PPP when they took it, but they didn't need it. So they gave it back. And it was a
Mm-hmm.
lot of money to give back. So I'm just wondering, is there like it to me, it seems natural to say, okay, I got PPP. Let's look at these other credits.
Yeah.
But isn't there an opportunity, like if you didn't maybe qualify for the PPP or you lost out, but you did keep your employees and you did pay that money and you did all of that? Isn't that really where you should be considering a potential credit as well, like
Mm-hmm.
regardless of the PPP
Yeah,
situation?
yeah, yeah. Because the main issue I usually tell people, if you qualified for both rounds of PPP, it's likely you'll qualify for ERC because the
Okay.
programs are somewhat similar. Um, and if you didn't get PPP for whatever reason, the program's closed, you can't go back at this point and get it. But you know, most people where they got PPP, we can't double dip on the wages that are used, and
Mhm.
so if you didn't get PPP, that now you don't have that being pulled out of your ERC, so you can qualify for potentially more. Um, but so that is a nice feature for people who didn't get the PPP money, is that it will potentially bump up your ERC. Just it depends on the timing, et cetera. But it is still a program, and I think for a lot of people who had concerns about, well, we're doing well, we don't need a handout, we don't want to do PPP. I'd say a distinction to consider for this program is it's really a tax credit, so it's not like a handout from the handout from the government in the same way. It's just baked into the tax law, so like how you're able to deduct expenses and be eligible for preferential treatment with rates or whatever it is. This credit program is the same way, so you do have like a legal entitlement to the money. It's not really, you don't have to take advantage of the program, but it's not the same thing as PPP, where it was at the government's discretion to hand it out. It was at the government's
Mm.
discretion to forgive it. You really do have a legal entitlement to this money, just like you have a legal obligation to pay your taxes. It's on that kind of same level. So I think for a lot of people who didn't do PPP for reasons beyond qualification, they didn't feel comfortable with um, doing a government aid program. This program's a little different because it is a credit. um, it's designed for you to take advantage of it.
Mhm. Well, and I think that one of the other things that I think I would be a little concerned about if I'm going down this path is the IRS and the
Yeah.
audit. And
Yeah.
so, do you think that the IRS is going to audit companies who take this ERC credit or at a certain level? Like,
Yeah.
can you already kind of envision what's they're going to start looking at? Because I think your audit, creating that audit file at the beginning is very important, just so that how you proved it out. Like we do that a lot in the
Yeah.
valuation, like
Yes.
how are you going to prove this out when you get to court?
Yep.
And so, but do you think that the IRS is going to target like thresholds or types of things? What do you
Mhm.
think is going to happen?
Yeah, what I think's going to happen, I think that we don't have these formal guidelines yet from them. But what I think will happen is that claims that are in a certain size will be selected for audit.
Hmm.
I think claims that don't make sense on the face of them will be selected for audit. So, for instance, if you've got, you know, a construction company in Florida that had increasing revenues for tax year 20 and 21, claiming the credit for all quarters, that doesn't make sense on the face of it. So,
Hmm.
they're going to look for things that don't make sense on the face of it. Now, if you're a restaurant in New York City and you're claiming for all quarters, that's a lot more likely. So, I would imagine that they're going to take an audit program like that, where they're going to look at cases that just, kind of statistically don't make sense and go after those. And then I think the other piece that they're going to do is they're going to select providers for audit. So, where we're seeing they've already given us a special pathway for whistleblower claims against bad providers. I think there's going to be a massive enforcement effort on a provider level, where they're going to just audit the whole provider, and then probably DOJ activity, for some of the negligence that's going on out there in the field. So I think that's how they're going to approach it. But we won't know until we get there. And, I think for a lot of the smaller claims, it's probably less likely that they're going to be audited, but we just really can't speak to that. So that's why I just treat every case that comes across my desk as if the agent's going to be contacting me, the minute it goes in the mail. Just because you have to, assume that that's going to be the case. And then, hopefully it won't be every single one gets audited, but it is going to be a highly enforced program just because of the dollar figures involved, because of the bad actor, the amount of, bad claims that are being filed. The IRS has issued warnings to employers to watch out for bad providers. So they have their eye on it, and it's coming. It's just a matter of time because they have a couple of years after the filings are done for a statute of limitations to come back. So, even if you file, get your checks, everything seems hunky-dory for a year, they can show up well after the fact, after the money's been spent even, and initiate an audit. So that's what we're anticipating.
Well, and I think the nuances of it, because there are some of these like kind of uniquenesses that create the eligibility and things like that, you're going to have practitioners that are just like, oh, 10 times 26,000, and you're going to have people that are kind of just doing this on a very easy, I always laugh when people say, oh, have you ever had an estate valuation go through an IRS audit? I was like, no. And they're like, well, how? And I'm like, because I base the valuation on reasonable assumptions. And so what I'm hearing you say is like, I'm basing the tax credit on our research, on our understanding, on your company. And here's the backup for that decision of what to put on the tax return. And if the IRS disagrees with us, they're going to come back, but we're going to have our reasoning. Yeah. And it's probably going to have, it's not going to be as aggressive, maybe as somebody who's just taking 26,000 multiplied by 10 employees and going for the credit, right?
Yeah, because that's what I see a lot of people do is, I'm dealing with trying to clean up messes from some of these situations where people will just say, oh, you business owner, did you have disruptions during the pandemic? And the business owner says, oh yeah, it was the whole pandemic. They say, okay, great. Then you qualify for the whole thing, and they're just basing it on a client attestation instead of the actual legwork and, following the rules from the IRS for substantiating documentation. And the client doesn't realize that that's what's happened. A lot of times the outside tax practitioner doesn't realize that's happened. I was on a phone call earlier today with another practitioner who his client was working with an outside law firm, and he was concerned because it was going to be a very large case. And I said, well, did they give you copies of the government orders? Did you ask for them? And he was like, no, they didn't. And I was like, well, ask for it. See what they've got. Because if they've got that and they're doing this and that and the other, it's probably fine. But people just don't realize, what goes into the background of these. It's not as simple as saying, okay, I paid, Sally, Susie and Sally and Jimmy X amount in wages. I'm going to times that by 70% and there's my credit. It's not as simple as that. And a lot of providers don't realize all of these rules and, the nuances, and they don't realize that there's amended income tax returns required and amended payroll tax returns required. They just don't realize all that goes into it. Now, and the business owner doesn't either. So
what did you just ask if we had the legal something?
Oh, the substantiating documentation.
Well, no, but when you said specifically, did they have the legal, like if you ask a practitioner some of these things and they look at you like deers in the headlight, like I did, they don't know. That's a problem.
Yeah. It's like, what's the copy of the government order? Like, it's going to be specifically Governor so-and-so's order, 16 dated May 15th, 2020. Like, is that what you're using? Like, what are you using for a government order? Because that's what it hinges on for a lot of, eligibility for people is government orders. And so if you don't have the physical order, and then also showing like, okay, it's paragraph this, subsection this, where it references this business type of, non-essential retail, capacity restriction 40%. Like if you don't have that, it just, the work hasn't been done. And a lot of people don't realize that.
Well, and it's interesting because those are the things we're usually looking for in a business interruption claim. And so
Mhm.
when the pandemic first started, the business interruption claims were contingent upon this, an executive order or
Yep.
something closing you down.
Yep.
And so you really had to know like what was it called? Because around the country
Mhm.
they were called
They're
different
all different.
things.
Yep.
They were certain, different restrictions. And so I completely understand. Now, another thing, like this is a little bit different, but in the same in the same space. What do you see in the future? In the future, we're going to see employee retention credit fraud increasing. But like, what does that
Yeah.
really look like? Because I'm trying to, in some capacity, that's not really a business owner coming to their accountant and saying, "Hey, I got 4 employees. Let's see what we got." That's a little bit, like when I think of fraud, I think of more like I'm trying to get a credit for 50 employees and I have 3,
Yeah.
right? But are there other like, are you already seeing some of this fraud come out? And is that where it's going, just sort of made up employees, or is it even more in depth than what I can envision?
Yeah, I think we've got, from what I see in the field, which is, a limited scope, and I talk to other practitioners about this a lot. It's a combination of, I'm sure there's just rampant fraud going on in the program just from me dealing with it. But more often it's negligence is really what
Mm,
it is.
okay.
It's people who are not tax professionals trying to do this work, who are underqualified to do the work. They don't understand the nuance of the tax code, because the other thing too is, it's one thing to maybe understand some parts of the program. It's another thing to understand how it interacts with the rest of the income tax code, because that's where it lives. And so, certain ways we have to interpret things or treat things come from completely other parts of the code.
Mhm.
So it's, unless you're an actual tax professional, you'd miss out on a lot of those things. So more often it's negligence is what it really is, and people trying to do this quickly, or just trying to do this as a profit, trying to generate these big credits and get contingent fees on them, and that sort of thing, rather than the focus being on, getting the work done correctly. Um, that's more what I see. And, this is going to be one of those situations where, my personal opinion is, like, I think a lot of people are going to end up in jail. Like, I think it's going to
Mm,
be a massive Department of Justice effort,
mm,
because I deal with some of the claims that I see. People come back to us. I look at who the provider was and how much they've said that they've filed for, and just how off the claim that I'm dealing with is, and extrapolating those numbers, and you're dealing with hundreds of millions of, if not billions of dollars in overstated, uh, negligently done claims. Like, that's the level that we're at with this program. So
mhm.
it's going to be it's going to be many years of unwinding from the IRS, to deal with it, and to deal with the backlash from it. But
Well,
that's what I see on the horizon.
and that's kind of a really important issue though, because if, for example, if you don't vet your person, right, and it's just your regular guy or somebody down the street, whatever, that's put a shingle up, because realistically, y- to put a shingle up and do this for like a year or two, not not maybe worth it, other than you guys to be efficient. But the reality is, if they do one kind of bad thing with another client, it could come back that the IRS is looking at all of the ones that they did, and yours is going to be one of them. And it could just be an unfortunate
Yeah.
event, but you have to be mindful of that. And I think in general, we'll talk next about like specifically, because I do want to talk specifically about your practice, because that's why I was so interested in talking more about it. But like in general, if people are around the country, all over the place, they can't necessarily, everybody can't go to you. What are some of the benefits with at least seeking out somebody who has specific experience in this area that we haven't necessarily talked about, um, but that you could maybe provide? Because I don't think this is just going to your accountant and saying, "Hey, do I get the credit?"
Yeah.
It's a little bit more, but maybe you can talk a little bit to that.
Yeah, well, I'd say, about our practice in general, I work with practitioners and clients all over the country because it's a federal tax credit. And so we're able to work with anybody that qualifies for it, whether you're in California where I am, or half of the year I'm in New Hampshire. We work with people all over the country on this program, and we work with, our main work that we do is we're kind of the ERC department for other tax practitioners. So most of our work comes from other tax practitioners who kind of looked under the hood of this thing and decided they didn't want to touch it. So that's what we do. And we work really nicely with outside tax pros because we handle basically the whole claims process other than, the amended income tax returns that are required. So this claim itself, just so you know, is filed on amended payroll tax returns, but it also requires amended income tax returns to get the claim actually, completed and done correctly because the credit interacts with your income tax situations from prior years. If you're claiming in 20 and 21, you'd have to go back and amend those returns. So we have to work with the outside tax pro to get that work done. But that's how our practice works with people. And, we track with the IRS, and then in the event of any kind of audit or inspection, we're there to handle it because it's what goes into these jobs. That's what we're expecting. The job's not done until it's gotten through audit because, that's going to be a high percentage of the cases.
Now, if I have my own accountant or accounting firm or whatever, maybe an internal accountant, external accountant, all of them, would it still be beneficial for me to contact you about this specific credit and still work with my other accountants?
Oh yeah, because it's usually what it is, for a lot of people, they'll start off by talking to their income tax professional to see if if you're dealing with a mid-sized firm or a large firm, very often they have a special department that does just these. So if you're in a situation like that, great, talk to them. If you want a second opinion, feel welcome to talk to us too. I usually tell people get 2 opinions, it doesn't cost you a phone call. So, you can start there, but I wouldn't sever an income tax relationship because they're not handling this specific idiosyncratic credit. So usually, usually when somebody finds me and not their CPA has found me, once I talk to the CPA and they're like, oh, you do this? Okay, great. I'm going to send you, the rest of my people because it's, I don't want to handle this. That's a lot of what we get from outside practitioners, when they find us through a client that we've done work for. So.
Oh yeah. I mean, I think people really need to understand that you keep your relationship with your accountant. This is like a special situation. Like, just figure out if it's money in your pocket, and if it's not, keep on going.
Yep.
Right. I mean, in some capacity. Now, for you guys specifically, though, you kind of have a proprietary process that, in building your file for the audit and such for the employee retention credit. But also, really, this was a product of, at the very beginning, you had a significant amount of clients that were seeking this, and it was very complex. And you kind of sought to, okay, if we're going to do this,
yeah,
we might as well put the time, effort to make it be an efficient process. Because you didn't have to. Like, you could have just been like, okay, we'll just do it for this period of time. So you really endeavored to kind of change how this was being processed and become a specialist in this space.
Yeah.
But what is the uniqueness of you guys? Just that you've been doing so many that you can see it quickly, or, what else would be a benefit for them to use you specifically?
Yeah, I'd say with us, and part of the reason that we did this is just seeing kind of how the IRS is, how we anticipate they're going to deal with the program is they're going to be auditing us as practitioners. And so by being able to have a lot of, the main concern for me was quality control and making sure that every single return that goes out, meets quality control standards. Everything's getting reviewed by a CPA. Everything is being triaged by, either a CPA or the attorney for the government orders, that we're maintaining all that documentation. And just, I decided, if we're going to do this, we need to really do it right. And to do that, you just need a lot of those kinds of safeguards in place through a process standpoint. And so that's what we did. We developed a lot of our own tools and technology and checklists and quality control measures and those sorts of things to make it, an efficient process for the client, an efficient process for us, but something where the quality control is really high, because that's, where I see that the issue is going to come up when the audits come, is being able to demonstrate, like, on every single case, it doesn't go out unless it's got, this and this, and we tie out to that, and we double check this, and that's going to what they're going to be looking for. So that's what we build. And then on the client side of it too, I was just really sensitive to, okay, business owners don't want to be spending 6, 7, 8 hours trying to deal with this thing. So if we can make the process simple for them, where it's just one checklist, 7 documents, introductions to outside providers for the things that we need. So like for, if they pay health benefits count towards the credit. Their payroll provider, we work with them directly to source the reports that we need, things like that. How do we make it easier on the clients? And that was, a big emphasis as well. So, I think most business owners who work with us, it maybe takes them an hour or two to get us all the documents, as long as they're, in fairly good order. And so that takes a lot of the pain points out of it for the client as well.
Mm-hmm. No, absolutely. And I think that, in this space, do you think that having even that legal side of it is also helpful? Because part of this is, those government shutdowns were more of municipality mandates, as opposed to like economic mandates or something like that. So it is kind of bringing all of these pieces together that looks like it's an accounting issue, but it's got a lot of legs to it, right?
Oh, yeah. No, and for, I think for the IRS enforcement issue, for companies that are using non-revenue qualifying factors, so like the government orders or supply chain disruptions, which I didn't even mention that one, because just as a warning on that one, if you have somebody telling you qualify under a supply chain disruption, it's probably not true, because it's really difficult to qualify under that part of the program. But we have an attorney on staff that's what he does, is writing technical memos and doing the analysis on what the orders were and going back to the clients, et cetera, because you do need legal interpretation, for those specifically. And, a lot of accountants just do not feel comfortable doing that, and rightfully so. Like, that's kind of out of the wheelhouse for a lot of income tax professionals to have to make, do a legal analysis on a government order. So that's something that we do as well for any case that's going to have that.
Well, and I think that that's what we're starting to see more often, that you do need a team of different background individuals that can look at the same issue from a lot of different perspectives. So I think that is super helpful. So we've put some information about how to contact you. Do you have that checklist or other information, resources on your website that people can get? Because I will say, I am not the ERC specialist. So if you have a question, you're going to need to call Catherine, not me. But I think that, if you have other resources on your website and things like that, they can kind of get started, understand. I love that it's a simple process. Is there anything else that we should know about this, or that you think is not being discussed that you wish maybe people would talk about?
No, I think we hit everything. I'd say in terms of resources, if I were you as a business owner, if this is your kind of wake up call to, okay, I've been getting, 30 robocalls and 6 emails a day from, companies that do not seem US based. I'm going to actually look into this thing. The place I would start if I were you, you can visit our website, and there's a For Business Owners page that's got a PDF on it. That's top 5 ERC mistakes, and it goes through like my top 5 red flags that I see from businesses. And then if you'd like to have your company assessed, visit the website. There's a See If I Qualify tool that asks for a few questions, and then we'll get in touch with you, and then it'll be one of the CPAs that talks to you to diagnose your situation and see if it's a program you can do. What we do for clients is we do that initial eligibility calculation as a complimentary thing, so that in the event you're not eligible for it, you've just lost your time. That's it. So that would be the process I would recommend. Definitely, talk to your CPA about it. See if they've really done the digging that's required. If they haven't, you can talk to our firm. If you're going to seek out other providers, I have some advice in the top 5 ERC mistakes PDF for how to source a good provider, things you should watch out for, and red flags. So you can review that as well if you want to talk to a couple different people. But I know I talk shop with a lot of other practitioners who do this work too, and we're all kind of in the same ballpark as far as approach, and you'll kind of feel if things are off. If you feel like you're being sold, and you're not talking to a tax professional, you're talking to a salesperson, that's a big red flag. You'll kind of know, because it's a technical tax credit. So you should feel like you're dealing with a nerd kind of a thing.
I mean, what do you have to lose? If I can call you up, you're going to take a look, you're going to get some documents, you're going to tell me if I can get it and then help. I mean, why would I not call you?
Yeah, we've tried to make it a painless thing. But I think a lot of people are just spooked by the audit, which is fair. But it's like, really the CPA like sending in some documents and fielding a phone call, I'm going to walk away from potentially $100,000. Like, for most business owners, it's like, all right, I'll take that risk. Especially when, like, for us as a provider, like, that's just baked into our engagement letter that we handled the audit. So it's it's really no risk on that. But
no, I think this was really helpful. And you're also a research for other accountants, other professionals, other attorneys going through this that may not know everything about it from the money side, but you can kind of come in. So please reach out to Catherine if you have questions. And I think she's been very pleasant to even talk about this. She can really nerd out to this information, but like, I do the same for valuation. So like, it's just numbers. We love them. What can we do? Well, if you have some more information in the future, there's a new tax credit. I'm going to get you back on the podcast, but I really appreciate it, Catherine. Thanks so much today.
Thank you so much for having me. I always love getting into the weeds on this one.
Yeah. All right.